Welcome again to hybrid accounts, and today we're just going to take a look at the topic called cost of capital. All right. So cost of capital in this one is found in financial management. All right. So if you haven't subscribed, you can just subscribe for regular updates by hitting the bell and then choosing all notifications. All right. In this section, we'll just take a look at introduction to financial management. All right. So what is cost of capital? What do we mean by cost of capital when we just encounter this term? Cost of capital simply means that an entity, when an entity to be in operation to purchase non-current assets, but also to have working capital, an entity would need funds. And right here, we can speak of long-term funds, right? Yeah, right here, I think that you are sending a message. No problem, you can just proceed. Let's just proceed. They'll come and find us here. All right, so when you speak of cost of capital, let's say maybe you need to start your business, but you need to borrow somewhere, you need to have debts, but also maybe you need shareholders. By shareholders coming, you will issue share capital, you will issue shares, they'll purchase such shares, you have funds as a company, and actually could use such funds to finance non-current assets and maybe partly working capital, right? Yeah. So by saying cost of capital, actually, you can be speaking of two viewpoints. So the aspects or viewpoints of cost of capital can be with reference to the company or the entity seeking funds, but also it can be with reference to the investors providing funds. That's why I'm saying it has two aspects, right? The cost of funds an entity raises and uses. You need funds, you go and borrow the bank, you have to pay them interest. You need funds, you issue shares, shareholders are subscribed and you have to pay them dividends. So that the cost of funds an entity raises and uses, right? But also it could be the return that investors expect to receive from providing funds to the entity. So it could be defined as the cost to the entity, but actually the return to the investors. So these are just two aspects of the cost of capital, right? Now, let's go to the definition itself. Cost of capital is simply the minimum return that an entity should make on its own investments so as to earn the cash flows sufficient to pay investors their return. All right? Actually, when dealing with the calculations of cost of capital, we'll know well the meaning of what I have just written down here. All right? So you as an investor, actually, you would borrow, but also when you invest somewhere, you would borrow maybe to have funds. But when you invest now, you expect to earn a return much higher than what you borrowed, so as to say that you have got the profit. So you can just define the minimum return an entity should make, or by this same definition, you can just change it and say that it is the bare minimum return that the firm must earn on the capital invested to keep the market value of the firm unchanged. Simply speaking, to keep the market value of the firm unchanged, we can just call it is IRR. I think you know IRR from the investment and price topic. It's called the internal rate of return. So simply speaking, the cost of capital can be determined at the internal rate of return. All right. Now, what does the cost of capital reflect? The cost of capital reflects the riskiness of providing funds. Be very careful on these questions of explanations. You could be asked in exams, for example, DCA exams. Cost of capital reflects the riskiness of the funds. If an investor considered that giving you such funds is very risky, they will require much higher compensation. You know, the higher the risk, the higher the return. They would require the much higher return. Now, the much higher required return to the investors means the much higher cost to the entity. And so the higher the risk, the higher the cost of capital. All right? Now, this means that the higher, as I just explained, the higher risk the investor, the higher the return they would seek. And the higher the return they would seek means that the entity would have to pay more. So this would mean the higher cost of capital to the entity. You have to be very, very conversant with these explanations. Now, let's just take a look at an example of this riskiness of the fund, because there are several sources of funds. You can have debt, you can have equity, you can have preference shares, several of them in different forms. So let's go to relative cost of sources of finance. For example, I would compare the debt and equity. The cost of debt is usually lower than the cost of equity. You have to explain this. And also, this is a very, very common question, especially in these exams. Cost of debt is usually lower than the cost of equity. Why? It's obvious that it will have a lower risk, right, to the investor. This is because now debt is less risky. That's why the lower the cost means the less the risk, the lower the risk. So this is because the debt is less risky from the debt holder's perspective. And why? Why would the debt be less risky? The following are the reasons. First of all, debt compared to equity, we say that in the event of liquidation, when the company is about to be liquidated, the creditor hierarchy requires debt finance to be paid off before equity. You know, when the company maybe has been insolvent and we need to close it down, we need to wind it down, actually what happens, there is a preference of paying those fund providers. Debt holders will be paid first, will be paid before equity holders, meaning that they are subjected to less risk. If they are subjected to less risk, that means they require less return. Requiring less return means that the entity will have to pay less cost. That's why we say its cost is cheaper. That's why we say this makes that investors demand a lower rate of return than equity investors. But the second reason, debt interest is tax deductible. As you know, debt delivers interest, while equity delivers what? Equity delivers dividend. Now, in the financial statements, dividend is always deducted from retained earnings. It won't appear in the income statement, but interest will appear in the income statement. I see your question. You say that will this lecture be available? Yes, it will be. It will be available. No problem. No problem. All right. So that interest is tax deductible on income, making it even cheaper to an entity. If you deduct debt, if you have interest and it is tax deductible, that means you have tax advantage. You have tax shield on such interest. But dividend does not have that in the income statement. All right. All right. Let's proceed now. Now we are saying again, arrangement costs are usually lower on debt finance than on equity. And again, unlike for equity, they are also tax allowable. You know, you have these issue costs when you need to secure debt, or maybe equity, you have to pay these flotation costs, right? Now, to pay those costs, we say that for debt, the costs are usually cheaper than for what? Than for equity. But in addition, there is also tax allowance, just like there is on interest, right? So the other reason. And last, you know, shareholders are not guaranteed with dividends. You know, when you borrow from someone, you guarantee them the interest. Maybe every year or every month you have to pay the interest. That one is known, it's given. But dividends, for dividends, shareholders are not guaranteed with dividends. It just depends on the discretion of the management, all right, or the board of directors. So that means that actually equity holders are subjected to much more risk. Being subjected to much more risk means that they require much higher return. Requiring much higher return means that an entity would have to incur much more cost. So those are the reasons. So in case you are asked this question, be very careful, be very prepared to answer it, right? All right. Now we can proceed here. Creditors hierarchy. Today we're just going to take a look at these explanations. Creditors hierarchy. What is creditors hierarchy? I just spoke of creditors hierarchy here maybe when you need to, when a company is wound up or when the company is liquidated, actually the providers of funds have to be paid. Now, who do we consider first in preference to the others? This is what we're going to ask ourselves here. All right, now, we mean the order of increasing. We have arranged them in the order of increasing risk and that the cost of capital from top to bottom. So the first people are the first fund providers to be considered are the secured creditors. You know, you can have creditors, but they can be secured creditors and then secured creditors. By saying secured creditors, I mean that you go somewhere, you go to an institution, you borrow, you have to leave your assets, some of your assets, on which actually they can capitalize when you fail to pay back the debts, right? So secured creditors. By saying secured creditors, it means that the investor actually would have reduced the risk because they would be almost certain of recovering the amounts actually that they lend to you. So for secured creditors, we usually divide them twice. We can have creditors Secured creditors on fixed charge. On a fixed charge, let's say you have taken your plant or your equipment, and you have put it actually against the debt that you have taken. So it could be on a fixed charge, or it could be secured creditors, but on a floating charge. On a floating charge means that you have used the asset actually to secure the loan on, let's say, assets like trade receivables. You know, trade receivables could be paid, you could receive them, actually you could use them, you are allowed. Maybe inventory, you're holding inventory, but actually you are not prevented. You are not prevented from selling such inventory. It's like trade receivables, you're not prevented from increasing it by selling more to credit customers, or actually receiving the cash from customers. It's allowed. So that's why we mean the floating charge. But also there are unsecured creditors. If creditors are unsecured, they will feel, oh, I'm not, there is no security. If there is no security, that means you have subjected them to much risk. If you subject them to much risk, they will require high return. And so that's why they are less in creditors hierarchy, right? Actually, so it's just like this. You mean that the cost will be higher, but here by creditors hierarchy, I just meant that the people that are considered first when being paid. All right, and now you can have preference shares, and then it's ordinary shares. So ordinary shares, which means equity provider, equity holders are usually the last in the creditors hierarchy. When they are paid, you start with secured creditors with fixed charge, secured creditors with floating charge, then unsecured creditors, and then preference shareholders, and lastly ordinary shareholders. So you should note this very, very well. All right. Now you will see the meaning of secured and secured creditors soon. Just a good example of calling these secured creditors is just, let's think of something called debentures and the bonds. You know, bonds are secured debts, but debentures are unsecured. All right. So let's go to factors influencing cost of capital. What factors could influence the cost of capital now? This one is also a very, very important topic, a very, very, very important question. Internal structure of the entity. The internal structure of the entity could influence the cost of capital. It could make the cost high or low. Why? A change in the entity's internal structure, you know, it may lead to a change in either the business risk or the financial risk. You know, by the business risk, let's say you are doing a certain business, you have changed to another business. The risk will change. If the risk increases, the fund providers would also be afraid of giving you funds. So they would be ready to give you funds at an increased return. That means an increased cost to the entity. So just like that, but also let's say need for finance. Let's say a lot of funds are needed. If a lot of funds are needed, it would mean that you need a lot of funds. It would mean that there is an increase in the weighted average cost of capital. Actually, you will see this weighted average cost of capital. It's a combination of all sources of finance. So there will be an increase in the weighted average cost of capital due to reasons like, let's say, additional flotation costs, because the flotation costs are incurred when you are securing new sources of funds. So to secure new sources, because you'll be needing more finance, you would have to secure new sources of funds. Securing new sources of funds, actually, you would have to pay flotation costs, to incur flotation costs. This one would increase the cost of capital. But also it could be that investors' required rate of return may increase for large amounts of capital compared to the entity size. You know, when you go to the investor to borrow or maybe to seek funds, the investor will look. The investor may consider that you need funds that are too much compared to your size. That means that the risk of you failing to pay them is high. And so they would consider this a high risk one, and they require a high return. All right. The third example is the third factor is capital market conditions. So it really depends on the capital market conditions. You know, capital market conditions could determine on whether the cost of capital is high or low. I think this is pretty much obvious on the capital market, right? Also, but we can have liquidity and the risk perception of the firm's securities, right? Liquidity and the risk perception. So in case of readily marketable securities, let's just take this an example. You know, let's say that an investor has invested the funds to you, but also those funds are very liquid. Being very liquid means that whenever they need to sell them, they can sell them. So they're not afraid. And maybe let's say the price is not so volatile. The volatility of that price, because you know when the price is very volatile, the investors would be afraid. Maybe by the time they need to sell their securities, maybe they would get much less amount, and so they would require much higher compensation for that. That's why we are saying, in case of readily marketable, liquid, and reasonably stable securities, investors actually would be content with a slightly lower rate of return, meaning a lower cost of capital. So these are the factors to consider. And then we can have changes in the capital structure. Now this one is obvious too. You know, the capital structure, maybe in the capital structure you could have equity, but also you could have debt. So to accommodate all these factors here, let's say retained earning, for example, is part of equity. So when at the end of the year, you have earned the profits, but those profits, most of them, they have been reinvested, they have gone to equity. You know, equity had the highest cost, as you just saw above. So this would mean that the cost of capital would rise, maybe unless you have secured other debts. So changes in capital structure could also affect this. But also we are saying management decisions, you know, it just depends on management decisions on how they decide. Let's say management are just risk seekers. They just go out there, they increase the risk of the entity by borrowing a lot. By borrowing a lot, that means gearing will increase and the risk of the entity failing to settle obligations would increase. So this could increase the cost of capital. And lastly, we can have macroeconomic factors. You know, a good example of macroeconomic factors could be interest rates. If an interest rate rise, that means that to borrow something would require you a much higher cost, right? When you need to compensate the investors, so the cost would also increase. All right, and then we can just go here to sources of finance. These are the sources of finance that we'll consider, and I think this is the last section for here. So we'll determine actually the cost of capital for the following. We'll consider equity. By saying equity now, actually, we'll use the following methods. So we'll consider the dividend growth model, or sometimes called Gordon's growth model. We'll consider the capital asset pricing model, CAPM, usually called CAPM, but also we'll consider cost of debt. And as for debt here, we would have several forms of debt. You can have tradable debt. Debt that is tradable can be redeemable, that means repayable, and can be irredeemable debt. That means repayable. All right. And when speaking of redeemable, this debt one can be called debentures or bonds or loan notes. The main difference between debentures and bonds is that bonds are secured debts, but debentures are not secured debts, but both of them are tradable. They can be traded in a stock market, right? Okay. And now you can also have non-tradable debt like bank loans. Bank loans are non-tradable. It's difficult to go, you usually not go to the bank and say, oh, this debt has a market value of a certain value. No, the bank lends money to you, you just have to pay them. They usually amortize those loans, they just have to pay them. All right. And then you can have the preference shares. So the preference shares can also be redeemable or can be irredeemable. By being redeemable, that means you have to pay them back just like debt. And by being irredeemable, that means you do not need to pay them back, just like for ordinary shares. So this was all about this section. And now what follows next would be starting to deal with this one, cost of equity using the dividend growth model, and then we'll come to cost of equity using capital asset pricing model, and then we will compare between dividend growth model and capital asset pricing model. All right. So if you haven't subscribed, I just advise you to do that so as to be able to secure all these videos.